Here at Stock Data Tracker, we collect past gappers and gainers to study how traders behave during these movements. The purpose of data collection is always to understand the topic better no matter what industry you're in. Although the past does not guarantee the future, historical data still gives us a clearer idea of how people will react given certain situations. You can capitalize on this understanding and take a position before the others react. Let's say you're interested in trading stocks that gapped up more than 100% from the previous close. You would probably study the charts of the recent occurrences to learn how to enter and exit a trade. What you're doing is basically tracking stock data. However, this has to be done over at least a year's worth of past occurrences in order for this idea to be somewhat reliable. Let's look at an example. It's reasonable to expect a stock that doubles its value during pre-market to fall during the market hours. After all, it is very unlikely for any catalyst or news to double the real value of any companies overnight. The hypothesis is, the current price is way above the real value of the stock and is bound to adjust itself downwards. With this hypothesis, we can do a broad test on how these stocks fare after 100 or more % gap up during pre-market. On a very superficial outlook, we can see these stocks fall by 8.7% on average from the opening to the closing price. Does that mean we should short sell these stocks at the open? These 100% gappers that traded at least 5 million shares in the day form an average high of 40% and an average low of -27% from their opening prices. In fact, if you look at this stock traded on September 23, 2020, it actually hit an insane high of 1,218% from its opening. That is why you need to study the past to maximize your gains and minimize your losses. Interested in understanding these types of stocks more? Visit stockdatatracker.com and get years of datasets to create and optimize your trading strategies.